Hey everyone, Peloton's stock price is down 97% off the high as the company looks to turn things around. Peloton I use as an example of huge management decision mistakes following the surge during the pandemic. Now, the newer management teams are trying to fix the mistakes that were made by those previous management teams in expanding too much too quickly. So I'm going to share with you those restructuring efforts and why I think Peloton stock could be an opportunity for those high risk, high return seeking investors looking for a turnaround play with big potential. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So like I mentioned, Peloton stock price is down 97.13% off the high. Peloton was surging during the pandemic, of course. As economies were shut down, people were spending time at home. Gyms were closed, and so they were looking for at-home exercise equipment. Peloton was the perfect match. Unfortunately, the management team at the time thought that growth in revenue would be longer lasting, and they made huge expansion investments. And then when gyms reopened, demand for Peloton's products collapsed, and they were left with all that extra manufacturing capacity they did not need. So now it is time for restructuring, shrinking the business, getting it aligned with current market demand. And that's precisely what the company is doing. On May 2nd, they announced a new restructuring program. This is on top of several others that will aim to reduce annual expenses by another $200 million. The objective is cost reductions and to match the business with the current size of demand, because they grew too much based on the surging demand during the pandemic. You would argue, well, shouldn't management have known that when gyms reopened, demand would fall? Well, hindsight is 2020. I would agree with you. Management should have understood that the demand was surging because gyms were closed, and when gyms reopened, their demand would decrease. But like I said, hindsight is 2020, and it's difficult for us to play armchair quarterback here and look back and say they should have known better, right? So their goal is to generate meaningful positive free cash flow, which they have achieved in the most recent quarter, and I'll share that with you a little bit later. So they expect to reduce their team size by approximately 15% or by 400 team members. And this is what I've been arguing for from Peloton, to continue shrinking, shrink down in size. You grew too much. Demand isn't there. Shrink down in size and manage the business effectively. Now, the good thing about Peloton's business is they have two sides: the hardware sales, right? The bikes, the treadmills, the rowing machines, and then the subscription side, which is the access to the interactive classes live and recorded. The subscription side of the business is incredibly profitable, very lucrative. And so if they can just get the hardware side of the business under control, where it's not losing money, it's just breaking even, to get customers over to the subscription side, it's a very lucrative business. But the hardware side was where all the trouble began. The management team invested too much in increasing capacity for these products. Now they're going to continue to reduce their retail showroom footprint, good, and they're also reimagining their go-to-market approach for our international markets to be more targeted and efficient. While they're not going to exit any international markets, they are going to be more focused and consolidate resources with localized execution. So they're going to focus more on the larger markets, more in their core markets, and not so much with the international expansion that they initiated during the pandemic when sales were booming. So that's another step forward. So they're mindful of their debt maturities, right? They had to borrow over $1 billion during their recovery phase, and that debt is going to come due. And they know that that's on the top of their mind. So they believe that achieving sustained positive cash flow makes Peloton a more attractive investment for debt holders. And that's true. If you shrink your business, you right-size your business, you generate consistent positive cash flow, then lenders are more interested in lending you money because they look at your business and they say, oh, it's a solid business. It might not be as large as it was before, but it's still making millions of dollars in free cash flow every quarter, millions of dollars in profit every year. So we're willing to lend this company money at a reasonable interest rate. Whereas if you're still losing money and you're still in recovery mode, then lenders are less interested. And if they lend you money, they're going to charge you a very high interest rate. So management is thinking correctly here in getting the business on sustainable footing first. And then once they get themselves on sustainable footing, generating consistent cash flow, they can then go back to lenders and say, let's refinance this debt. Let's get it, on more attractive terms. So more good news for Peloton. In the third quarter, they restarted delivering the Tread Plus to their members, and this was 3 years off the market. This was another fumble the company made in their rush to get new products to market. The Tread Plus had issues and they had to recall, and now they're just now getting it back to consumers. They also started rental because their equipment can be so expensive, it's prohibitively expensive. They're allowing consumers to rent instead of buy, and that continues to outperform. New rentals were up 10% year over year. And then last week, they started selling Peloton Tread and Peloton Row on Amazon to distribute these products to a larger audience. That's also good news. Amazon has hundreds of millions of Prime members. And by selling them through Amazon, you expose yourself to more buyers. And I think it's worth whatever you have to pay Amazon, so long as it's not exorbitant, to get access to those large buyer audiences. Additionally, they announced a partnership with Hyatt Hotels that includes outfitting more than 800 Hyatt properties with Peloton equipment. And hotels are a great match for Peloton. Hotels like to have their little fitness centers, and Peloton is best in class in terms of the exercise equipment. And so partnering with hotels to get Peloton equipment in there could be a great win-win relationship, because Peloton can make a large batch sale all at once to these companies and deliver it all at once. And the delivery and installation per unit cost can be lower because they're making all the delivery and all the installation at one location instead of having to distribute to multiple households with that level of purchase orders. So that's a good win there. I hope to see more from Peloton in this category. All right, so Peloton has 3 million paid fitness subscriptions. That's the lucrative business that I talked about. The trouble is that this business is not growing because they're not selling many new bikes. And then at the same time, every month, there's a certain number of people that cancel, right? 1.2% churn. So that means roughly 1% of their members cancel. And if they're not making enough new sales, their membership will decrease. Thankfully, it's not decreasing quickly. It's relatively flat, but they are expecting a small decrease in the next quarter. And here I want to discuss the lucrative side of the business. So let me share with you here. You look at the connected fitness products gross margin, 4.2%, just 4.2%. It's great news that it's positive because it was negative 5.4% in the third quarter last year, in the same quarter last year. And it had been negative for a long time, but now it's finally on the right footing, 2 consecutive quarters at least of positive gross profit margin. And then the people that buy the bike or treadmill or rowing machine, they get access to the monthly subscription. And that's typically between $40 and $50 per month. And that's a very lucrative business model, 68% gross profit margin there. That's the part of the business I would want to own, is that subscription business. So if you can just sell those bikes or treadmills or rowing machines, whatever it might be, at a break even or slightly positive, and then get those people into the subscription where more than 98% of them renew their subscription, that's a great business model. That's where they need to be. They need to shrink the manufacturing enough so they're not losing money on that side of the business and just focus on getting people into those subscriptions. And then in the latest quarter, like I mentioned, cash flow from operations positive, 11.6 million. Free cash flow also positive, 8.6 million. And then looking at the balance sheet, it is troubled, but it's in much better shape now than it was a year ago or even 6 months ago. They have $794 million in cash and equivalents and $354 million in inventory. That inventory is down from $522 million, and that inventory had been as much as over $1 billion. So they've done a good job working down that inventory while still maintaining solid cash flow from operations and solid profit margin. Here's the troubling part. They have $991 million of senior convertible notes and a $692 million total term note. So 1.6 billion in debt. And these are not at low interest rates. These are at higher interest rates. So if the company can continue this positive cash flow from operations, it can then refinance that debt at a lower interest expense, which can then lower its interest expenses, then boost profitability. And that can be a positive virtuous cycle here as it works down that long-term debt balance. So the better cash flow it generates, the more it could work down that long-term debt, and the better that can boost profitability because you're paying lower interest expense, and it can continue to feed on itself for a while until it pays down that debt. So finally, after the huge sell-off, Peloton is trading at a forward price to earnings of 0.5, which I think is a relatively attractive price considering everything, considering the risk and considering the opportunity. So I have Peloton stock rated as a borderline buy, and this should only be considered for investors with very high risk tolerance because there's a chance that things can go badly wrong and the company could be in a desperate position in a short amount of time. So this should only be considered for the high risk tolerant investors looking for a opportunity for big gains, but also a stock that comes with huge risk. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.